Hi, and welcome back to Tim Bingham's Options and Volatility newsletter. Taking a look today at a one-day wonder, I'm calling it, right? A overnight, if you will, reversion in implied volatility in POET Technologies, POET, as Thursday was the day we initiated the trade. Friday was the day we closed it out, as IV reverted on Friday. As you know, IV generally jumped big time on Friday with the massive stock sell off, but it even points out how implied volatility and monitoring it can really provide that edge in trading. So let's jump in and take a look. First of all, here is the link to that video I sent out basically on Thursday, highlighting the trade and why we did the trade. Here's the scanner I built on Thinkorswim. This is from Tuesday, right? Identified POET across the board. Massive unusual option activity, especially on the call side, as you can see. Another scanner that I use, right, identified it the following day on Wednesday. POET even more big volume coming in, now over 500,000 traded versus less than 18,000 on average, 31 times the volume. Now implied volatility at 80%. And taking a look at IV, we can take a look at it that first day that we looked at, right? That big jump in IV based on that initial unusual activity call buying. As you can see here, how much implied volatility shot up, right? Almost 40 vol points, right? You can see calls now trading at a big premium to similar puts, which is something unusual, as well as huge call volume drove it, right? IV percentile, right, was at 80%. So certainly getting expensive on a comparative basis. Here's that big call buying, right, coming in. You can see it lifted IV massively across the spectrum. So this kind of alerted us to the potential for that trade. Then on Wednesday, we saw even more volume come in, as we said, right, with that big volume coming in on, that we saw on this particular day, right, with 539,000 contracts trading, right. You can see lifted the IV even more so, right. You can see that certainly got to an extreme IV percentile now at 100%. You can see trading at by far the highest implied volatility level over the past year. Here is that huge repeat call buying, right? Here's that 539,000 contracts trading, right, on Wednesday. Again, lifted the IV across the entire term structure of volatility, right? And here you can see it heading even higher, which set up ideally for our trade idea on Thursday morning. Here it is looking at it in a slightly different form, but you can see IV had remained constant. This is kind of the slightly out of the money calls and puts on a 30 and 90-day basis. Here's that day of the first unusual option activity coming in. Then the second day lifted to here. That's set up ideally for the trades that we got into, which was selling the November 8 put, selling the November 12 call. The stock was trading right around 9 and change at the time, so both were out of the money. Plenty of cushion on both sides. Then, lo and behold, you can fast forward to Friday. You can see here we are selling the rip, right? That is what we took a look at, looking at IV back here, right? Then all we did was wait for the dip, which happened the next day, right? So we were able to sell it on Thursday morning, and lo and behold, by Friday, it had dropped back enough to become very nicely profitable. We never wait for it to revert back to where it was before, right? It gets very sticky, the reversion down here, but certainly this kind of reversion can set up ideally for the trade. Here it is looking at that different look at implied volatility. Here is the trade idea when it was generated, right? The IV over 170. You can see the reversion over the next 2 days with IV dropping. Note too that even though calls are trading still at a premium, they've lost some of their luster, if you will, here. Here is the other look at implied volatility across the 3 days. Here's that first day on Wednesday. Here it is on Thursday. And then lo and behold, on Friday, we saw that big drop. So this sets up ideally, right, for that vol capture trade that we talked about. As far as the actual trade, we talked about it in the original trade video, so certainly you can take a deeper dive there. But we basically sold November 8 put, November 12 call, right, for $2.90 net credit. The reason is because about a week earlier, with the stock actually below the $8 strike price by a large margin, right, the spread was trading at just over $2. So that huge lift in IV drove up the price of that sell strangle, right? Even though it was an ideal price, right? It was out of the money on the puts and calls both, but for the fact that IV shot up so much because of that massive, unusual option activity, especially on the call side, lifted the price of this sell strangle to an extreme, to say the least. So able to sell 177 or so IV with the stock at $9.23, a $2.90 net credit. Then when we saw that big reversion come in, right, when we saw the dip start to happen, so we're able to sell up here, buy it back down here, we are able to cover that trade at $2.20 net debit, even with the stock now going in the money on the puts, right? Our $8 put, which was the put side of the string we sold, the stock was at $7.70 roughly. So the puts have now become in the money you'd expect, right? The ideal spot is somewhere around $10, right? Or $9.23 certainly is nice. Ideal. It got less ideal, yet the trade cheapened for a profit. Why? Because we saw this huge IV reversion of almost, 28.5 vol points, or over 15% reversion just in one day, right? So we're able to put it on at 290 on Thursday, covered at 220 on Friday. And again, Friday was the day when IV shot through the roof. We saw the market have the biggest down day since April, right? We saw the VIX at the highest level since those Liberation Day kind of lows, right? So even with vol generally heading higher, the fact poet vol dropped so sharply is a testament to identifying these huge, unusual option-based spikes in IV to structure trades. Also took off the margin requirement on the trade. So this is just doing it one time, right? The margin requirement for selling that naked call, selling that naked put, right? And this is a low price stock, so not a big margin requirement at all. But the margin overall, $550. That includes the option premium on both sides. So the net you would have tied up, right, would have been $290, if you will, of your own money, because you brought in, or $260 because you brought in $290 by selling that spread initially. So the net margin in essence tied up $260, able to make 70 cents or $70 on the trade basically in one day on that reversion, selling it at 290, buying it at 220, right? Selling it at a 177 and change, buying it just under 150 on the IV side. The stock, ideal price up here, right? In between the two strike prices, almost equidistant between them. Here, now the puts are in the money, which is normally a negative for a sell strangle, but because IV reverted so much, it ended up being a positive on that. So our net overall return, right, over 25% net return, which is that $70 divided by the net margin needed to do the trade, right, all overnight in one day. So the ability to make over a 25% return on a fairly neutral trade that's hedged, right? You're selling a call and a put both, simply based on the fact that you saw that huge spike in implied volatility. Take advantage of that, sell the rip, and then wait for almost inevitably the dip to take the trade off. Structure it, position size it in a fashion that makes sense, because at the end of the day, as we know, trading is all about probabilities, not certainty. So find the edge, then put on the hedge. So until next time, as always, here's the good trading. Take care.